The second set of ratios that we are looking at are the profitability ratios. Now, clearly these assess how efficiently the business is at generating profit. And for the AQA A level, the first two ratios that we need to look at are not on the AQA formula list. They're not on the list because they were part of Buzz 1 and Buzz 2 exams. First ratio is the gross profit percent. This ratio looks at the gross profit of the business, and the gross profit is the sales minus the cost of sales, difference between what you paid for the goods you're selling and what you sold them for, so that's your gross profit, and we divide that by the sales revenue, total amount of money the business has received from selling goods, times by 100 to get a percentage. We generally reckon a gross profit percentage of around 70% is what we're aiming for. Second profitability percentage is the net profit percent. And here we take the net profit or operating profit of the business, and this is the gross profit minus all your other expenses. So this is what you actually end up with. So it's net profit or operating profit divided again by the sales revenue times 100%. We would generally look for a ratio of around 20%. However, some really competitive businesses, like supermarkets, only have a ratio of 2 to 3%. The third profitability ratio we look at is ROCE, Return on Capital Employed. This is a measure of how much money the business is making compared to the total amount of money invested. So how efficiently is the business using money invested to generate profit? So we're looking at operating profit. So this is operating profit before tax, and we're comparing that with total equity, which is the total amount of money from shareholders added to non-current liabilities. This is long-term loans. And sometimes this is shown as a negative number because the business has to pay it back, but we ignore the negatives in this equation. So total equity plus non-current liabilities is the total amount of money that's been invested in the business. So ROCE is comparing operating profit with total money invested. In other words, how well is the business using money that's been invested to generate profit? Again, times 100 to get a percentage. Really rough rule of thumb would be 10%, would be a good ratio, but really you've got to compare it to other options and look and see if it's getting worse or getting better.